Okay, thank you. So since we're only given 2 hours to do the final exam, I will definitely give a less number of exam quiz problems, probably around 60 to 70 questions. So much less than um, what you guys had for the final, for the midterm exam. Okay, but because we're covering very intense topics from chapter 7, 8, 9, and going forward, and I just have to give you quite a number of questions that is doable within 2 hours for the final exam. And since it is only 2 hours, I'm thinking of doing just focusing on the parts after the midterm rather than giving you a comprehensive exam, which includes the midterms chapters. Okay, but I haven't really finalized the format for the final exam, but that's just the like idea that I have at the moment. Okay, but anyways, final exam December 14th. That's Monday from 6 p.m. to 8 p.m. You will all, like we did for the midterm, we're gonna do the exam on Connect. So in order to avoid any technical glitches that some students had during the midterm exam, please make sure that you do not close accidentally the browser and make sure that your internet connection is stable. Okay. But yeah, that's like a month from today. So don't worry about it for the final exam. But again, quiz is due this week from Friday to Sunday. Okay. Any questions before we get into today's lecture? Okay, so that's good. So today we're going to focus on long-term liabilities. So we've gone a long way, okay? Looking at the balance sheet, we covered current assets, non-current assets, current liabilities so far up until chapter 8. Today we're going to focus on non-current liabilities, okay? So long-term liabilities or non-current liabilities, okay? So today we're going to focus on, like Michael said previously, we're going to focus on bonds and long-term bank loans, and how the interests are calculated, how much the borrower pays for the loans or the bonds, and the capital structure of the company. So all this very important items that you should really know in terms of understanding balance sheet, in terms of financing for the projects that a company might have going forward. Okay. So first, we're going to focus on the types of long-term debts. Okay. So for financing alternatives, for the companies, they have different ways to come up with funding in order to run a businesses. Now, before we get into debt financing or equity financing, there are, by and large, two main ways to fund a project. Fund the project. One is the internal source. Okay, internal source of funding. So for the internal source, we talked about briefly this on the first day of our lecture, which was when we talked about the shareholders' equity portion of the balance sheet. So for the internal source of the funding, we're mostly talking about profits that a company makes from their everyday business operations. So for example, Apple sells iPhones or Macs, and the profits from selling those items that will be used for funding or financing a future projects that the Apple company might engage in. For example, Tesla, they sell vehicles, Model 3, Model X, and from selling those vehicles, the company will make profits. So those profits will be redirected to finance any other projects that this might be going on. So for example, I think there was yesterday or 2 days ago where the SpaceX successfully launched another satellites to an international space station. So any profits that the company makes from their everyday business operations can be used to fund other projects. Okay. For example, Walmart, I mean, we all know Walmart, they sell a variety of merchandises. And from those sales, the company makes profits. And again, those profits can be used to fund or finance any other projects that the company might engage in later. Okay. So those are usually categorized as the internal source of funding. Um, and since you're talking about internal sources, what about external? Okay, external source of funding. Source of funding, and that's where this debt financing or equity financing comes into play. Okay, so for debt financing, that's pretty much straightforward. So companies go to a bank and try to take out a loan from the bank. So that's just one example of debt financing. For equity financing, it might be not relatable as an individual person, but basically equity financing means that there are investors who are making an investment to a company, and in return, they are receiving a share, right? So if I buy a Tesla stock or Apple stock, in other words, they are making an investment to a company, and that investment, it will be treated as an equity financing, okay? Now, but what about the difference? What's the difference between the debt financing and equity financing? The most important difference between debt financing and equity financing is how it is treated in terms of tax implications. So as I laid out here, if you take out a loans, obviously you, yes, Fensock is talking on the chat, so that's very good. Well, anyways, for debt financing, since you're borrowing a money from bank, you are obligated to pay interest, right? So those interest expenses will occur as you borrow money from banks, and that is tax deductible. So remember, when we look at the income statement, you had sales revenues right here, and then you had cost of goods sold, all the minuses right there, and there was an profit margin, right? Profit margin, and in below there was one accounting item called interest expenses, and that will bring the revenue, or that will bring the net income down, which will help reduce tax liabilities that the company pays at the end of the year, right? So that's tax deductible. But for equity financing, as a company, you are only obligated, not obligated, but you have an option to pay out dividends. That's the only potential obligations that the company might have to engage in terms of payouts, right? So dividends, but unlike interest expenses, dividends are not tax deductible, but the recipients of the dividends are obligated to pay taxes on that dividends, right? So it's not the company who's responsible for tax payment, but it's the shareholders who are receiving the dividends that are responsible for paying the tax, right? The examples of that, we're going to focus on notes and leases and bonds. Okay. Any questions on different types of financing and internal source of financing, external sources of financing? Okay, so that's good. Before we move on to the next slide, I just want to talk briefly about our accounting equations, right? So we had an asset equals liability plus shareholders' equity. When a company draws money by issuing a debt, that means the liability will increase. Okay. Now, if the company sources funding from issuing equity or issuing shares, in other words, that means you are increasing the shareholders' equity portion of the accounting equation. That's just the difference between the debt financing and equity financing. And obviously, depending on what your focus is or what you are putting emphasis on in terms of the ratio analysis that we briefly talked about previously. If you want to reduce the liabilities, you might want to go for equity financing. But when you are more focusing on the shareholders equity portion, you might want to go for this liability section in order to reduce what you're focusing on. Okay. Any questions? Okay. Before we get into, let me just go over this. So which of the following statement is true? Profits generated by a company are a source of not external financing, but they are sources of internal financing. Dividends paid are tax deductible? No, dividends are not tax deductible. Only those who are receiving dividends are supposed to pay for taxes. Companies who are paying dividends are not responsible for the taxes. Interest paid on that is taxable. Yes, we just covered this a few minutes ago. So Jason is asking, does borrowing money as a company also increase asset? Of course. So in terms of the journal entry, when you borrow money from a bank, for example, you're going to debit cash, right? So I mean, let's just put 100, and then you will incur another liability, 100. So that cash will increase an asset, right? So, oh yeah, Michael just answers that question and the liabilities too. So yes, I like this dynamics of asking and answering questions simultaneously on the chat box. That's very good. Any other questions before we move on? Okay, so before we get into this installment notes, I just wanted to cover a few things that you guys might not be familiar with. So we just talked about different types of financing, debt financing and equity financing, how they are different, and the implications depending on the types of financing. But the question is, as a manager or as a CEO or CFO of a company, let's say a company needs $10 million, okay, $1 million to fund or finance a project, a new project, okay? As a CEO or as a CFO, how are you going to raise that $10 million to finance a project? That's the key questions. Well, that's the basically the everyday financing questions as CEO, CFO, or a manager of a company. So that's a very important question because depending on the types of financing, that will have a huge implications on your balance sheet, on your ratio analysis, on your interest expenses, as well as on your taxes, right? So, I mean, there are various possibilities. One is the company can just draw or take out the entire $10 million, okay, $10 million through debt, right? You can
usually banks don't lend you 100% of a project, though. I mean, typically.
Yeah. We're gonna get there. Hold on. Yeah, we like the experiences, but let me just cover the basics, and then we'll get into what's really happening in the real world. Okay. So, I mean, that's so option number one is a company can approach a bank and then ask for the entire $10 million, and then the bank will evaluate those projects and then determine whether or not the $10 million is a great investment from the bank's perspective, and whether there's any default risk involved in terms with respect to this project. So that's option number one. Number two, as a company, you can issue bonds. Okay. If you're not familiar with the bonds, you can hold on for now. Let me just quickly cover the scenarios here. But as a company, they can issue a bond with interest. Okay, they are quite similar to the bank loans, but they can issue bonds for the entire $10 million, and they can use that $10 million to finance a project. I mean, another option is they can issue a new shares, right? Those shares can be sold to an investor, and the proceeds from those issuing shares can be used to finance a new project. So, and then the last option is hybrid. Let me just write it. Hybrid or a mixture. Okay. So a company might borrow $5 million from a bank, and for the remaining $5 million, they can issue new shares to investors or issue bonds to finance. So depending on the situation, depending on the company financials, and depending on the market condition, company has a variety of choices to finance in new projects. Now, the question is, what's the optimal, okay, optimal level of financing? Okay. As an accountant in the future, most of you guys, you don't really have to know this optimal level of financing, but I just wanted to introduce today what I, as an academic person, do when we're dealing with the managerial decisions with respect to financing, the optimal level of financing. Jason Lin is asking, do they find the WACC? I'm not quite familiar with what that WACC is. So if Jason can explain a little bit more about what the WACC is, I'll be glad to address that question. So if you're ever interested in pursuing academic career rather than practitioner's career, here I'm just gonna provide you one example what finance academics do in terms of determining the optimal level of financing. So Stuart Myers is a very well-known academic in
That was going to
finance.
be your paper.
My paper is different. My paper is on politics, so it's a whole different story. But yeah, in academics, Stuart Myers is a very highly renowned academic in finance. So what he lays out in this 1984 paper is that they are introducing this idea called packing order theory. So what that means is that according to the packing order theory, firms prefer internal source of funding. So whenever they need whenever they need funds to finance a new projects, first they're going to draw money from their internal source of internal source. So we talked about the profits from everyday operations. So they will first consume that portion of the funding from the internal sources. And then if they still need more funds to finance a project, they will then move on to external funds. And then within the external funds, we talked about debts and equity, which one comes first? And then according to the pecking order theory, they say that firms usually choose debt over the equity. And there are whole variety of reasons as to why a firm would like to prefers to use debt instead of equity. In this paper, a very lengthy paper, but the fundamental question is this: how do firms choose their capital structure? I mean, how much they're going to use for financing on the loans, how much they're going to use for bonds in order to finance. So that whole decision, managerial decision, was the focus in this paper. And they're saying that we do not really know how firms choose the debt, equity, or hybrid securities they issue. And then they talk about the trade-off framework and packing order framework. But basically what they're saying is that firms usually prefers internal source of funding first, and then they move on to external financing. And then within the external financing, they prefers debt instead of the equity if it issues securities. So, I mean, this 1984 paper is very old. So I took the liberty of digging into some internet sources. So this will be more clear and easier to understand. So according to the packing order theory, let me go over to here. So this is the graphical illustration. So just like we discussed previously, companies usually prefer internal financing first, coming from the retained earnings. And then whenever they need more funding sources, they move on to debt issuance. And then they will consider issuing more equity into the market whenever they need more sources. Now, the reason why there is a hierarchy, or the process as we see right here is, uh, can see, I think, these three paragraphs. Okay. And this is very interesting if you read carefully. So when a company finances an investment opportunity to external financing, a higher return is demanded because creditors and investors possess less information regarding the company. So we, in academics, we usually talk about this idea of information asymmetry. Asymmetry. So what that means is that in the market, there are managers of a company, right? There are CEOs and CFOs within the company, and there are creditors like banks who lends money, and there are investors or shareholders, okay? I mean, intuitively, managers have most of the information about the company because they are basically working within the firm. They can obtain any information about the forecast of a company, any plans that the company might engage in the future. So managers have a superior information set compared to creditors and investors, because creditors, banks, or shareholders, they are basically outsiders from the company. So unless the manager decides to provide more information, their information set is limited. Okay. Because the information is limited, they usually require a higher return. What that means is that when, for example, we talked about $10 million projects, so creditors will require $10 million plus interest, okay? Interest in order to compensate this limited information set, okay? That's what's happening right here. So
the funny thing about that is it's implying that the internal source of funding in the firm should have a lower cost of capital than debt, which
of course, I mean,
that doesn't
more
make
of the there is not even a capital. You just makes money from selling products, so there's not an interest component associated to it. So it's not even a capital. It's just the money sitting in your own bank account, right?
well, but you have a okay. This is accounting. I'll leave you alone. Sorry,
Yeah.
I won't do that.
Okay. So again, creditors, investors, they have less information regarding a company as opposed to managers. So in terms of external financing, managers prefer to use debt over equity. So the issuance of debt often signals an undervalued stock and confidence that the board believes the investment is profitable. So what that means is that the fact that the company is issuing debt or borrowing money from banks, that basically signals the market that the stock price is undervalued, and the board believes that the investment is profitable. So what that means is that as a bank who are lending money to a company, they would not lend money to a company if they think that the project will not make any profits, right? So as long as there's a confidence that these projects will make profits, the banks are going to be willing to lend money to a company, right? And that's basically what this is saying. The investment will be profitable. Now, on the other hand, the issuance of equity sends a negative signal that the stock is overvalued. So what that means is that, let me just draw a line. Okay. Let's say the true value of a stock is $10, but in the market, that same stock is trading at $12. Just like we talked about for Tesla, right? Tesla stock skyrocketed throughout this year, and a lot of analysts are saying the stock price was overpriced. That's basically it. So the fact that the company is issuing equity indicates that the stock is overvalued, and it's a negative sign to a market, right? So the management is looking to generate financing by diluting shares in the company. So I think this news came out yesterday. Pfizer CEO, right? We talked about Moderna having 95% of effectiveness with respect to their vaccines. About 2 days ago, Pfizer came out saying that their vaccine was also as effective as Moderna at about 90%. And at the same day, Pfizer CEO company basically sold his stocks, but 60% of his stocks the same day. I mean, if you are CEO of a company and the vaccine is very effective, why would the CEO sell his stocks to a market? It's just a question that the market had. It was a huge news that were circulating in the market, right? So Jason Lin is saying, aren't those planned on in advance? Could be. I didn't really read the news in detail, but yes, as a CEO, if you want to sell your stocks in the market in a great amount, one is that the CEO has to disclose that information at least in advance before actually selling their stocks, and that information should be disclosed in their financial disclosures and in their 8Ks. But anyways, the question is the timing of these news. The timing of the news on the same day that the company issued a news saying that their vaccine is very effective at 90%. The CEO is also at the same simultaneously selling his stock, 60% of his stock to market. Kind of draws any attention to or any curiosity or any doubts, right, as to the motivation as to why the company why would the CEO sell his stock to the market, right? I guess it's illegal, but is it ethical? I mean, we don't want to talk about ethical issues here in this class or any other classes because different people have different standards, different understanding of which one's ethical, which one's not ethical. We only care about legality here. What's legal, what's illegal, and the ramifications and implications with respect to the behaviors and the decisions of the managerial decisions. Okay.
Professor.
Yeah.
So based on him selling 60% is that he does not believe in his own company, right? If you
It
take a
is
look at
one
it,
possible. Yeah, it is one possible interpretation, but
Or he's getting a divorce and he has to pay his wife $50,000.
yeah, that's another way. Yeah, man. Yeah.
don't know.
What's his? The Amazon CEO, right? He gave a bunch of stocks of Amazon's to his ex-wife, right?
hmm
Yeah.
and
But what's the
but
question?
oh yeah, by the way, Tesla will be entering into S&P this December, so they
Oh, they're
skyrocketed.
trying again?
No, they did, and now it's already inside. So coming December, they will be inside. So it just increased in 5 minutes, like 12-13% increase in the shares. So just went up.
Yeah, I mean, getting into this S&P 500 is a huge deal, right? Yeah, so there are a lot of things going on in the stock market that I really want you to take some time to go over this financial news and the disclosures and earnings announcements and there are quite a lot of things going on in the market. But as an introductory accounting course, I don't have that much time to go over these recent, important, meaningful news articles. But I highly recommend that you follow what's really going on in the stock market. But anyways, back to this optimal level of theory. Anyways, so at the end of the day, basically, yeah, I'm diverting so much. So what I wanted to introduce was that as an academic, not practitioner, yeah, we talk about this optimal level of financing. What's the optimal level with respect to the amount of debt financing relative to equity financing? It's quite interesting if you actually take some time to go read these academic papers that are coming out in various academic institutions. But I mean, if anyone is interested in pursuing academic career rather than say working in public accounting firms or private accounting firms, please let me know. I can provide you a glimpse, a little bit of a glimpse of what you can expect as you pursue your academic career in accounting or in finance. Okay, but anyways, enough of that. Let's get back to our textbook. So we talked about debt financing, equity financing. So let's get into the real examples, right? So notes and leases and bonds. So first, we're going to cover installment notes. Okay, that's so. For example, if you take out an education loan, personally, I have about $30,000 of education loan from Federal Credit Union. So every month I have to pay back $291 every month to the Federal Credit Union for 30 years, right? So in politics, they talk about student loans debt-free, right? Policy.
A high interest rate. Wow.
Yeah, I hope
Like
that
I bet that's
they pass this law so that I don't have to pay back this entire $30,000. But anyways, so this $291 is basically an installment payment for my education loan of $30,000. Okay. So installment notes. So if you go to a car dealer to buy a vehicle, or if you're taking out mortgage to finance, not finance, but to buy a house, right? You will have this installment notes, basically saying, basically in other words, that you will make on a monthly installment payments in order to pay back what you took out from the original at the initiation, right? So for each installment payment, there will be an interest component associated with the loan. Also, there will be a reduction of outstanding loan balances. So what that means is that in this case, my example, this $291, for example, $200 will go to my interest payment and only $91 will go to my principal repayment. Okay. And as you pay back every month for 30 years, that proportion, I guess, will change. So in the first month, it will be $200 for interest and $91 for principal. In the next month, it'll be $199 for interest and $92 for principal. So the proportion between the interest payment and principal will change as you pay back your original instrument notes. Okay, but we're going to cover that when we get into the actual amortization table. But any questions so far with respect to the instrument notes? Okay, so that's good. So this is the table, like a simplified table that you will get during the exam, during the quiz, and in the real world as well. If you ask for an amortization table for your education loan. So here, we are going to assume that a company borrows $25,000, 6% interest for your loan for a new delivery truck on November 1st, 2021. Payment or monthly payment is $587 are required at the end of every month for 48 months here. Okay, so for installment notes, this amortization table is very important. You should be very familiar with how the table is structured, how these each individual numbers are calculated, and what individual numbers imply with respect to the interest payments as well as the principal payments. Okay, so let me just go through one by one from line to line in order to help you understand this entire amortization table. Okay, so we're gonna start. So first, let me just structure the table. So we have the date, obviously, very important component. We have a cash payment, the actual payment to the lender, and then we have an interest expenses column, and then there's a difference column. So this one is very important. And lastly, the carrying value of the loan. Okay, so we're going to start with the entire $25,000 here, because this is the amount that the borrow or the company borrows from the bank, right? So this entire $25,000, we're going to start from that. And that was made on November 1st. So on November 30th, I guess, on November 30th, given the information here, the company will pay back $587.13 to the lender. Okay. Now, that's the second column. Let me just draw clearly. And that cash payment column is very easy. Here, it's the number is given. So every month, you are going to record $587.13 at the end of every month. So we're going to repeat that process. But that interest expense column will change as you move forward. So in the first line here, you are going to use the carrying value of the previous period, which was $25,000, and you are going to multiply that with the 6%. 6%. So the 6% was given in the information. And since we're talking about just 1 month of time period, we're going to multiply that by 1/12. And the number is given, and that's $125,000. Not thousand, $125, right? So what that means is that we had $25,000 of the principal amount, and then because of the interest rate, $125 of interest will accrue as a month has elapsed. But in reality, you are actually paying back more than what the interest has accrued, right? Well, interest is only for $125, but you're actually making $587. So there is a difference, right? And the difference is given, which is $462.13. So that difference, $462, will be used to reduce the carrying value of your installment note. Okay, so from 25,000, you're going to reduce by 462.13. So that's 24,537 point some numbers, right? So any confusions at this point? It is very important and critical that you understand the process of preparing this amortization table. Let me just repeat one more step. So that was November 30th. What about December 31st? As usual, you're going to pay back the same amount, $587.13. Now, for the interest expenses, now you're going to change the number here. So previously you used $25,000, but now your new updated carrying value of the note is 24,537.87. That's the new updated carrying value. You're going to multiply that by 6% and also multiply it by 1/12, right? And the new number is $122.69. And as you can see, the number decreases, right? So the number decreases as time elapses. But anyways, so there's a difference. So the interest has accrued by $122, but you are actually paying back more at $587. So there is a difference. Difference is $464.44, and that difference will reduce the carrying value of your notes and bringing down to $24,073. Okay. So if you repeat this process for 48 periods, at the end of the day, your carrying value will converge to 0, because as you keep going forward, you're reducing the carrying value of the loan bit by bit by the difference at every period. Okay. Any questions on this amortization table?
Professor.
Yeah.
Do we need to know how the 587.13 is
Oh, yes,
calculated?
I'm gonna cover that way later, like at slides like 40 something.
Okay,
Yeah,
thank you.
but as we're just starting to cover the topic, the number is given.
Why do they call it carrying value?
Because the value of the notes keeps changing, right? So you want to update the value of your notes, and in the way you I guess address the idea of changing the value, they use the item called carrying value or book value. You can also use book
Okay,
value
book
of the
value.
notes.
I'm I'm shocked. I've never heard the word carrying value.
Oh, well, carrying value is used all the time. I mean,
Okay.
they're interchangeable basically. I mean,
Book value all the time.
yeah, I
Carrying-
mean, at what amount is this note recorded in the balance sheet? So that's the carrying value or
I know,
book
I
value.
understand what it is. I
Yeah.
just, the term I
Mhm.
got. Okay.
Yeah, great. Mhm. Any other questions? Okay, so again, it's very important that you understand how amortization table is constructed, how these numbers are calculated, and the implications of the difference between the cash payment and the interest expense accrual. Okay. Um, so for example, in the exam or in the quiz, you might be asked to compute this number. For example, can I change number? Oh no, I can't. So I can just blank out this number and then ask students to compute the dollar amounts for that blank. And you should be able to come up with the correct number for that column or for that blank. Okay. And as you can see, even though the cash payment number stays the same throughout the period, the interest expense amounts or the difference or the change of the period we're going to keep changing as you go forward with respect to these installment notes. Okay. So we talked about the amortization table, and since we're talking about accounting, how about the journal entry, right? So on November 1st, which was at the initiation of the notes, the company will receive the entire cash, right? $25,000 on debit, and you are going to record notes payable at $25,000, right? Very easy stuff. Now, it gets very tricky, right? Do I want to bring up this idea? So in previous chapters, right, whenever we're given, so let's say we don't know this, we don't know this information. Let's say the company borrows $25,000 at 6% 4-year loan from a bank. The usual journal entry was it. So at the original date, we record this debit cash, credit notes payable, and after 1 month, for example, November 30th, we would usually record interest expenses, the amount at $25,000 times 6% times 1/12, which was 125. And then interest payable at $125. Remember, I mean, are you guys familiar with this journal entry? And on December 31st, we would record another interest expenses with the same amount, $125 and interest payable and $125. This was the usual journal entry that we used to record when we talked about in previous chapters, right? But in this case, it's different because the interest expense number keeps changing at every month. And the question is, why is this different from what we used to discuss in prior chapters? Any ideas?
Because your loan balance changes every month. It goes down.
Yes. Yes, that's
So
one thing.
you're paying more principal each payment and less interest.
That's
Like
one.
It's like a
Yes.
pyramid, basically.
Now, the key difference is that when we talked about this loan, it was basically a promissory notes. Promissory notes, in other words, a very short-term loan, okay? And according to the contract, what that contract was saying was that you just pay me the interest, right? You just pay me interest and you pay me the entire principal at the end of the term. That was the contract for the promissory notes that we usually we use when we used to talk about these loans. But in this case, this is a different types of loan. It's an installment note. So what that is that unlike promissory notes that you're only obligated to pay interest for the duration of the terms, for instruments, you are not only paying back interest, but you're also paying a portion of principal. So basically, the contract term or the details of the contract is very different from the regular, should I say regular, from the notes that we used to talk about previously, and this instrument notes. Again, the key difference is for promissory notes, the original principal amount was to be paid at the end of the term, but for instrument notes, a portion of your principal is also paid back as you're paying back throughout the period. That's the key difference. And that's why the interest expense dollar amounts keeps changing at every period. Okay, that's the key difference. Any questions? Okay, so again, back to the journal entry. So here, so for November 30th journal entry, you're going to credit cash for the entire $587.13. So that's easy, right? The entire cash amount of $587 is paid back by crediting it. And the question is, what are you going to put on the debit side? Okay. First is the interest expense, right? So as you're borrowing money, you're going to record an interest expense. The amount was $125, as you can see right here. And there is a difference, which was here. Okay, so 460. So that difference will be recorded here under notes payable. $462.13. And that by debiting the notes payable, what that means is that you're going to reduce the notes, reduce the liability, right? So that difference of $460 will be debited under notes payable account. And that's what you're seeing right here. Okay. So as you can see right here, you are paying a larger amount of money in cash on top of the interest expense, and the difference will be directed or allocated for the repayment of the principal amount under notes payable. And for December 31st, same idea applies. So you're paying back $587 in cash, and you're going to also record a debit of interest expenses, and the dollar amount was $122.69, as you can see right here. And there is a difference of $464, and that difference will be debited to notes payable. That will bring down the principal amount of your original note. Okay. Any questions?
There's no special requirement for prepayment of principal, right?
Oh, your
payments
or the early termination. We're gonna also cover that like at slides 30 something. Yeah, but yeah, very good. Any other questions? Okay. So before we move on to the next slides, remember last week, 2 weeks ago, when we talked about current liabilities, when you take out a loan, right? Let's say $10 million due 10 years, due 10 years, for example. We broke this $10 million into current portion and non-current portion, right? Remember that? Very important. So let's try that. So given this amortization table here, okay, the question is, at the end of 2021, or December 31st, 2021, in the balance sheet, at how much is the company going to record this loan under current section and non-current section, given this table? Any guesstimates that you guys can think of? So out of the entire $25,000, as you can see right here, how much of that $25,000 will be attributed to current portion, and how much of the remaining portion will be attributed to non-current liability?
Is it 1 year as non-current?
Yes, so current portion is the loan that is due within 1 year. Non-current portion is beyond 1 year. Remember? Ooh, somebody. So Brooks is saying, how about $25,000 minus 18? So I think you're referring to this number. Very nice approach, but not quite correct.
Is it 25 divided by 4? So 1 year is 6250. So first year, 12 months.
Okay. Nope. Nope.
It's not straight line amortization.
It's not. Okay, so let me just give you an answer. So we're talking about December 31st, 2021, right? So on December 31st, 2021, the carrying value of the loan, we have 24, right? We have $24,000, $73.43. So that's the starting number. So Brooks was quite right, but the beginning number was wrong.
I think
So
it's
at the
5,758.
yes, so you're starting from 2473.43. So that's the remaining, or the carrying value, book value of your loan right here at the end of 2021. Now, out of that 24,000, let's go to the next year, December 31st, 2022, right here. So December 31st, 2022, your remaining amount is 18,315.65. Okay, so what that means is that the difference between these two, were attributable to the current liabilities portion, and the remaining 18,315 was attributable to non-current liability section. Okay, but Brooks was quite right, but it was not the $25,000, it was $24,073, but very nice catch. I like that. Okay, so again, at the end of 2021, your carrying value of your notes was $24,073. At the end of 2022, your balance, or the carrying value of your loan, was 18,315. So what that tells me is that the difference between these two numbers was attributable to this within 1 year period in the year of 2022. And that number was to be reported on the current liability sections, and the remaining 18,000 was to be attributable to non-current liability section. Okay. Any questions? Okay, so that's good. I think we have some more time to cover. So most notes payable require periodic instrument payment. Each instrument payment includes an amount that represents interest expense. So we know that. So when you're paying back, a portion of that will go to the interest expenses, and the remaining amount will be used to reduce the carrying value of the remaining loan balance. Okay, so this is the key concept that you have to understand, memorize, and be familiar with when it comes to quizzes and exams. Okay, so let's try this question. So this company borrows $24,000 and agrees to a 5% 5-year instrument note loan with a bank. Payments of $452 are due at the end of each month. How much interest should be recorded for the first month? I mean, that's easy. For the first month, your carrying value will start with $24,000, right? So you're going to use that $24,000, multiply that by 5%, and 1/12 to address this 1 month time elapse period. Okay, so that will give you $100. For the second month, obviously the number will change, right? So your repayment was $452.91, but your interest portion was only $100. So the difference, $352.91, will be used to reduce the principal amount. So what that tells me is that 24,000 minus 352.91. Let me just quickly do math. I know I can do this. 4 9 6 3 2. So this will be the carrying value of your loan after the first month, and you're going to multiply that by 5% and another multiplication of 1/12 to get the new updated interest expense for the second month. Okay. Any questions? Okay, so that was instrument notes. Now it's time to move on to another example of long-term liability, which is bonds. Okay, so bonds are quite simple. Even though you might not be familiar with how bonds works in the market, it's basically simple. It's similar to it's like a similar to simple calculation or simple loans, for example. Promissory notes. So bonds are basically a debt instrument that obligates the borrower to repay a stated amount, referred to as the principal or face amount, at a specified maturity date. So what that means is that you will have, let's just draw a timeline. So year 1, you're going to you're going to issue this debt instrument called a bond. For example, $10,000. So you will have that $10,000 in your pocket in year 1. And for year 2, 3, 4, 5, you're going to pay interest. Let's say the interest is 5%. That means you're going to pay $500 interest, $500, and another $500 on a yearly basis. And at the end of the term, you're going to pay back the entire $10,000. Okay, so this is quite similar to what we used to talk about when it comes to borrowing money from the bank, right? So quite similar in this case with bonds. So the borrower also agrees to pay interest over the life of the bond. And traditionally, interest on bonds is paid twice a year. In other words, semi-annually on designated interest dates. So in this case, it was an annual basis. But if we change this to semi-annual basis, what that means is that on June 30th, you are going to pay interest $250. On December 31st, you're going to pay another $250. Same idea goes here, okay? But just different number of repayments, but at the same amount, okay? So this is basically bonds. Oh yeah, I had a graphical illustration. So on January 1st, 2021, this company raised money for development of its new roller coaster by issuing $100,000 of bonds, paying at a stated interest rate at 7% each year. Bonds are due in 10 years with interest payable semi-annually on June 30th and December 31st each year. Okay, so on January 1st, 2021, the company will receive this entire $100,000 by issuing this debt instrument. And throughout the period, you're going to pay interest at $3,500. And that number comes from the original principal amount, $100,000, multiplied it by 7%. And since the interest is paid semi-annually, you're going to multiply a fraction, 6 over 12, in order to compute the interest payment, which comes down to $3,500. Okay. So you're going to repeat this process for 20 times. So the bonds are due in 10 years. It is due in 10 years. If you're paying twice a year, in total, you're going to repeat this process for 20 times, right? So at the end of 2030, at maturity, the company will pay the interest of $3,500 as well as the original principal amount of $100,000. That's the structure of the bond. Okay. Any questions? Okay. So let me just talk about briefly the difference between bank loans and bonds. Okay. So today I'm more focused on the practical use or how the real world works rather than just covering the topics that are laid out in the textbook. So in terms of financing, we talked about these bank loans, and now we are covering bonds. What is the difference between these two types of debt instruments? So for that bank loans, it's easy. You go to a bank, okay? You go to a bank and ask for money in order to finance the projects. So there's only one lender, lender in this case. Now, just like what Michael talked about previously, when a company goes to a bank for loans, it's not usually just one bank that lends money. It actually makes a syndicate. It's called a syndicated loan. What that means that multiple banks gather together, and then for example, this 10.
They become co-lenders.
Yeah.
They're
Yes,
all-
I like that term, co-lenders.
Yeah, they're
This. So let's say a company goes to a bank asking for $10 million. It's not just the one bank that will finance this entire $10 million. It's going to be multiple banks that are lending lending to make this entire $10 million. So for example, Bank of America will lend, for example, $5 million. Chase will lend $3 million. Other banks will join and then lend $2 million. It's usually how this works in the real world, because bearing this entire $10 million in their profile is very risky, right? So if this company actually defaults, that means this entire $10 million will become nothing for this one particular bank. So in order to avoid the possibility of the defaults, multiple banks actually join into this syndicated loan to basically dilute the default risk among the banks. Okay, but there are going to be what is called a lead bank, who are arranging everything from top to bottom. But again, in terms of the dollars, there are going to be multiple banks joining this syndicate. Okay, and there's a whole syndicated loan market in the real world. I'm not going to go into the detail. Okay, but that's the characteristics of the banks. So basically, one lender or very small number of lenders in terms of bank loans. For bonds, there are going to be multiple lenders, and we call it bond holders. So just similar to shareholders or stockholders, there are going to be quite a number of bond holders that are lending money to a company. Okay, Brooks saying book runner. I like that term. Michael saying administrative agent. Those are some of the terms that are used in the market. But for this class per se. Just know the difference between the bank loans and the loan and the bonds. Okay.
Professor.
Yeah.
By the way, is the interest fixed for both of this, or it's different?
Interest
It
is
depends-
fixed. What?
Is the interest fixed on bonds?
Yes. The bonds
Really?
will have a stated interest rates.
Oh, okay.
Mhm.
So it doesn't change due to the market, right?
No. For loans, I forgot the term. For loans, there depending on the contract. For example, my education loan has a variable interest rate.
Okay.
Variable interest rate. So it was the year 2010 when I
What was
borrowed the money. So the interest was very low, right? I mean, the
Oh, wow.
government was nearly at the bankrupt, so interest was nearly at 0%. But now 2020, thanks to no, I have to be politically unbiased. Because of the market condition, the interest rate is higher than 0%. So I'm paying more for my interest for my education loan, but depending on the contract. So if you have a variable interest rate, your interest will change as the government rate changes. If you have a fixed interest, your interest will not change throughout the term. Okay. So
Yeah.
Brooks is saying LIBOR. So LIBOR is one of the interest rates that are used to price the loan. Yeah, I like that.
You should have done a fixed rate.
Yeah.
You should have done a fixed rate. You should have taken a fixed rate.
Yeah, but it was the financial crisis, and I just didn't have much choice, right? Actually, to tell you the truth, back in 2010, my initial interest rate, even though it was an education loan, it was 8.25%, very high, right?
Yeah.
But now my interest rate is at 10%, 10.25%.
The housing market went down because they
I
forced
know.
everyone to take variable rates,
So,
right?
like I said previously, my principal amount for education loan is $30,000. What that means is that every year I'm paying interest of $3,000 every year to a bank. And I'm so sad. I'm just basically giving a salary to the person in charge of my loan. So I have to pay back my education loan as soon as possible whenever I start making money. But yeah. So why are we talking about this? Oh yeah. But anyways, so to my knowledge, bond interests do not really change. For bank loans, depending on the contract, whether you have a variable interest rate or a fixed interest rate. Justin is saying, my only experience with bond is from the movie, The Big Short. Whether woo, movies. So what was the name of the movie? The Wolf, I forgot. Or the I forgot. And there was another movie. Anyways, yeah, let's not talk about the movie. Yes, there you go. Wolf of Wall Street. And then there was another movie that I really liked. The Margin Call. Okay, so if you're really interested in this margin call, interested in the idea of finance, Margin Call is another great movie that you can enjoy with respect to how the market is doing, right? Yeah, Jeremy Irons. Yeah. Whew. Anyways, yes, whenever we talk about these long-term loans or long-term liabilities, there are a lot of stuff that are going on in the world. Let's not talk about IAG. Yeah, I have whole issues with AIG, how they are bailed out during the financial crisis. Anyways, yeah. So should I want to proceed or do I want to take a break? So let's just cover a little bit more before we take a break. So let's start with recording the issuance of the bonds and related interest. So previously, so one of the students was asking, is this number given or are we responsible for calculating on your own? So we're going to get into that part. So here, the face value of the bond was $100,000, and this entire $100,000 was the proceeds or was the cash that the company received by issuing this debt instrument. But in reality, that may not be the case. And you will gonna talk about why, okay? Yes, so here. So first, using the same example above, this same company issues $100,000 of bonds paying 7% interest rate for 7% interest. So at the initiation of the bond, you're going to receive the entire $100,000 and you're going to record a bond payable with the same amount, $100,000. And for the interest expenses, we calculated the numbers, the $100,000, multiplied it by 7%, and also another multiply with 6/12 fraction because the company is paying semi-annually. So that's where the $3,500 is coming from. Now, this is the case where the stated interest rate equals to the market rate. So what that means is that if the bond is saying that I'm going to pay the bondholders 7% interest rate semi-annually, and for this bondholders, when they look at similar bonds and the market is also paying 7% interest rate for the similar bonds, in that case, you're going to receive the exact same amount that you see on the bonds on the bonds, okay? So how should I phrase that? So let's say I have a company A. I have a company A and I have company B. Okay, company B. Company A needs money to finance a project and they decide to issue a bond at 7% interest rate. Assuming that company A and company B are quite similar in terms of default risk, in terms of financial strength, in terms of company portfolios, assuming that the company also pays 7%. In this case, this bond will receive the exact same amount of what you see on the bonds, which was $100,000. But it is also possible that even though these two companies are quite similar, the company B might be paying 6% for the bonds, right? Or it could be also possible that company will pay 8% for their bonds instead of 7%. If that is the case, what is the impact on the bonds of company A? That's the question that we're going to discuss right here. Okay, so the stated interest rate is the specified interest rate in the bond contract. So that 7% stays the same throughout the period. Now there's another key term here, market interest rate. It's not specified in the bond contract. It's basically the interest rate or bond interest rate that is paid by another company of a company of a similar default risk, similar financial strength or financial solidity. So we're going to compare these two interest rate in order to determine whether the bonds of company A's will be issued at premium or at discount. Okay, so intuitively, if my bond is paying 7% when the market is paying only 6%, what that means is that my bond will be valued at premium because I'm paying more than what the market is paying, right? In this case, my bond is paying at 7% when the market will give you a higher interest rate, which is 8%. In that case, my bond will be issued at discount. And in terms of the implication and impact on the principal amount, for example, let's say this was $100,000 of bonds. If the bond is issued at premium, your proceeds or the cash receipt at the initiation of the bond issuance will be higher than $100,000. So for example, it could be $120,000. For discount, it could be like $90,000 because the bond was issued at discount. Okay. Now, the way, I should say, we're not, for now, just understand the concept of this premium or discount, and how the bond is issued, at what amount the bond is issued. So the determination of whether the bond is issued at premium or at discount, depending on your stated interest rate and the market interest rate. All right. But any confusions or questions on this? Okay, that's good. So just to summarize, if your bond has a higher interest rate than the market, I'm paying more than the market what gives, that means my bond will be issued at premium. If my interest rate is lower than what the market is giving, that means my bond will be issued at discount. Okay, so that's the concept that you have to understand before we move on. Okay, and then another thing that I want to cover before we get into actual calculation is this. So for bonds, so the assumption was that we're comparing these two companies of similar default risk and similar financial strengths and solidity. But how do you know whether we are comparing the similar companies? And this is where this credit rating comes into play. Okay, so I don't know whether you guys ever heard of the company called Moody's, Standard and Poor's, or Fitch Ratings. So these three companies are basically responsible for evaluating the company's financials and evaluating each company's default risk. And then they assign this letter grade, okay? Letter grade with respect to the financial strengths of the company. So if you are triple A level, according to Moody's, you are in pretty much in good shape, and then have the lowest likelihood of going default risk. If you are around this BA1 level, that means your company is at risk, at default, and their recommendation is do not invest in the company because the company are going to go default at the end of the bond term. Okay. FinStock is saying S&P 500 started because of the Standard Poor's. Yeah, I mean S&P 500, S&P right here, right? Quite similar. But anyways, so basically these are the comparisons. So this BAA3 or BBB minus, depending on what companies are using, this is basically the margin or the lowest level, the lowest level that the company recommends investors to invest. Below that level, they do not really recommend you to invest in the company because the likelihood of that company going into bankrupt is very likely at the end of the bond terms. Okay, so companies or bondholders use this table to compare the companies. So let's say I'm investing in a bond of a company at a level of A3 right here. You're going to compare that bond with a company in the A3 level of the bonds and then see how the interest rates are different between these two companies. Okay. Any questions? Okay. Yes, so we covered a lot so far. So let me just, okay. So Iraldo is asking, why aren't the ratings standardized? Because this is not governments doing it. They are private companies, okay? So Moody's have their own standards of evaluating companies. Standard Poor's have their own criteria and standards to evaluate the companies. Same goes to Fitch and ratings. So even though they are at the same level, so A3 of Moody's and A- of Standard & Poor's are located in the same level, that doesn't necessarily saying that they are like 100% same with respect to default risk, because they have different ways of evaluating companies. It's just a rough comparison, depending on which company you're using in terms of evaluating the bonds and evaluating the company. And that's why we don't have the standardized metric, I guess. Yeah, metric for the comparing ones. So let me just cover this. So bonds issued at a discount. So you have the face value, face amount or principal of $100,000 of bonds at 7% interest rate. Now, assuming the market is paying 8%, okay? So market is paying 8% when my bond is only paying at 7%. That means the bond will be issued at discount. So you're not getting the entire $100,000, but instead you're only going to receive $93,000 by issuing this bond, and the difference will be recorded under discount on bonds payable, $6,795. Okay.
Can you talk more about what that discount on bond payable is? I understand you only get the 93,000, but is this like a contra asset? What is it?
This is contra liabilities account. So you have bonds payable, right?
Yeah.
So you have got bonds payable. What that discount is doing is by bringing the bonds payable by $6,795. So it's a contra liabilities account, if it is easier to understand.
So hold on, contra liability. I can picture contra asset, contra liability. It's like
bringing the number down. Yeah.
You're decreasing.
Yeah, you're decreasing.
Well, yeah, but it isn't a contra liability an asset?
No. The payable is a liability.
I understand that, but a contra liability.
Contra liability. Should I say contra liability? Or if it is easier, you can just think of it as, so we talked about depreciation, right? Depreciation, you had, for example, equipment, and then below that you had accumulated depreciation.
Yeah, which is a contra asset.
Yeah. So that's basically it. So you have bonds payable, and that discounts will bring the value down by 6,700. It's like a similar approach here. Accumulated depreciation, discounts on bond payable. Okay, but anyways, so again, your bond is paying at 7%, market is giving at 8%, so there are going to be a discount. In terms of the dollar value, it is $6,795. Now the question is, how did we come up with this $93,205, right? And that's the topic that we're going to cover right after the break. Okay. Any questions before we take a break?
The contra liability.
Yeah.
So I'm just thinking about the discount on bond payable a little bit. So I understand that the discount would decrease over time, right? Okay. All right. I guess I just have to think about it, look at the book, and think on my own.
Okay. Okay. Yeah. But anyways, but if we don't have any questions, we're gonna take a 20-minute break. So we're gonna come back at 7:52. Okay. So see you soon. Okay, so it's 7:56. Why don't we continue our conversation on bonds? But before we get into bonds, just a side note, whenever I talk about this chapter, long-term liabilities, bonds, and notes, I always talk about this thing that makes students become very interested. So I don't know how many of you guys are familiar with the idea of the Federal Reserve Bank. But before getting to that, so we talked about a lot of things that's what's going on in the real world, in the market, right? We talked about bonds, we talked about, in the chat, we talked about LIBOR, we talked about syndicated loans, and then we talked about a lot of things, right? Dividends, interest expenses. It's because basically the market, or the how the market operates in 21st century are basically based on this long-term finances. You don't really need like physical money to run operations. And then most of the money that we're talking about is basically the numbers that you see on the computers, right? That doesn't really exist. Now, let me just search this. Just give me 5 minutes, and I think you are going to be fascinated by what I'm going to present. So let's talk about dollars. Let me just bring up a picture. Can everybody see the picture here? Okay. This is quite interesting. So if you examine the dollar bill here, it actually says Federal Reserve notes. Okay, so it's a note actually. So when we're talking about notes, it basically means someone is borrowing money and someone is lending money, right? So I don't know how many of you are already know this, but the dollars that we use in everyday business activities to purchase merchandise, they are not actually, how should I say this? They are not technically the U.S. government asset or U.S. government property. They are actually the property of the Federal Reserve. So Federal Reserve is the one that is lending this dollar bill to the U.S. government, and the U.S. and the population in the U.S. are basically using this money that the Federal Reserve is lending to the U.S. government. So it's a note. So what that means is that the U.S. government has to pay interest to the Federal Reserve because they're essentially lending money. And if you actually take a look at the Federal Reserve, this is the official website of the Federal Reserve. They are required by the law to transfer net earnings to the U.S. Treasury after providing all necessary expenses to the Federal Reserve, legally required dividend payouts. So if the Federal Reserve is part of the U.S. government, there are not going to be any discussion about making profits, right? But the fact that the Federal Reserve is talking about earnings, dividends, and maintaining the balance in the surplus bonds, that kind of tells me, or tells some folks who are very interested in this conspiracy theory, that the U.S. government is actually run by this independent or semi-independent or quasi-independent organization, I guess, rather than the U.S. government itself. Well, but it's just a conspiracy theory. But actually, yes, Federal Reserve, the head of the Federal Reserve is appointed by the president, and they are run by the Congress. But in fact, if you actually get into really in detail in a deep state, or I don't want to say in deep state, but it's quite interesting how the U.S. government is actually working. Yeah. Some talk about reducing the Fed Reserve balances. But I mean, just a side note that I wanted to just briefly introduce, that the dollar bills that we use is actually not the property of the U.S. government. It's actually the notes that the U.S. government is actually borrowing from the Federal Reserve. And whether the Federal Reserve is Federal Reserve, or if you actually search for who owns the Federal Reserve, a lot of things actually talked about on the internet. Which one's right, which one's wrong, and I can't really tell you, but it's actually quite story. But anyways, at the end of the day, what I wanted to say is, this economy that we're talking about is actually run by long-term liabilities. Even the basic monetary currency, the dollar bill, is run by long-term liabilities. This financing, debt financing, equity financing is also run by this long-term financing. So the whole idea of long-term financing is a key to understanding how the economy is run, how the market is operating in 21st century. But yeah, that's like 3-4 minutes. Ron Paul audit the Fed. Yeah. Anyways, so I just wanted to talk about briefly about the dollar bills. Let me just close that out. So why don't we get back to our today's lecture material? So we talked about discounts and premiums of the bonds. So what's important is to be able to calculate the issue price or the proceeds from the bonds. Yeah, so this is the amortization table used for bonds. But before I even get into this amortization table, I want to get into how this number, $93,000, $205 is calculated. So before we talk about the method to calculating that number, we have to talk about time value of money. Value of money. So in finance, in economics, and in accounting, time has value. Time is money. Time has important implications when it comes to evaluating or quantifying any products. So what that means is that for $1 today that you have, you can invest in a company, in a company, or you can lend money to somebody or to a company. So basically, with $1 today, you can make, for example, $1.2, $3, depending on the portfolio. You can make money out of it, right? So that time period required to reach to $1.2, $1.3, because of the opportunities that you can make money out of an investment. In finance, economics, and accounting, we say that time has value in terms of the money. Okay, or in other words, this $1 today worth way more than the $1 in year 2, for example. Okay. Year 2. That's the basic idea. Again, with $1 that you have today, you can deposit the money in the bank, in the savings account, and then you can make interest revenue out of it. You can invest in shares and get dividends, or you can lend money to another person and get interest revenues as well. So because of that idea, $1 that you have today worth way more than the $1 that you will have in the future. So that's basically the idea of the time value of money. Now the question is, how do you quantify, or how do you calculate what the dollar value will be like in year 2, year 3, and year 4 with the $1 in year 1? And that's where the financial calculator comes into play, or the Excel comes into play, or the time value of money table comes into play. Okay, so how should I say this? So for this course, I'm not going to focus on the use of the financial calculators because we cannot really physically meet each other, but I'm going to cover the use of Excels in order to compute the dollar values and the use of this time value of money tables. Okay, so what this table will tell you is that given these various interest rates and given the periods, so it could be 1 year, year 2, 3, 4, it could be 1 month, 2 months, 3 months, but at the end of the day, $1 of today, for example, with the interest rate of 5% and in year 10 will worth $0.6 in the future. Okay, so that's basically the idea. Okay, or let's say the interest rate is 10% in the market, and after 10 years, my $1 today will worth only 0.386 or 38 or 39 cents in year 10. That's basically it. So this is the table that you were supposed to use in our in-person class, but because we're not meeting in person, I'm just going to introduce how this table is used. Okay. So what that present value table will tell you is that with the $1 that you have today, depending on the interest rates and depending on the number of periods, how much of that $1 will worth into the future. That's basically what this table will tell you. Okay. Now, what about this present value of an annuity table? So the difference between annuity and just a simple table is that you only have, for present value table, you only have $1 in the beginning of the period, and you're going to calculate how much of that $1 will worth into the future. For this present value of an annuity table, what that will tell you is that whenever you take out loans, for example, so you're taking out loans, and for the duration of the loans, you're going to pay interest, right? So you're going to make a periodic payments. So you're going to basically calculate how the periodic payments will worth in the lump sum amount in the present value. Okay, so we only had $1 value in the table above. For annuity table, you're going to use this periodic payments in order to calculate the lump sum amount of the total of the interest expenses, considering the present value, the time value of money. Okay, and that's why you see much larger number here, because there are multiple periods of payments. Okay. Now, understanding this time value of money and understanding this table, let's get into how that number, let's go back to here, that $93,000 are calculated. Okay. So the information given is this. Face value of the bond is $100,000. Okay. You have stated interest rate as 7%. Okay. You have the market rate at 8%. Okay. It was due 10 years, right? The number of periods is 10 years. So these four information is the ones that are needed in order to calculate $93,000. Okay. Now, keep in mind that interest is paid semi-annually. Okay. So remember, it was not $7,000; it was $3,500. So we are going to convert that into 3.5%, 4%. And since the interest is paid semi-annually, 10 years will become 20 number of periods. Okay. So given this information, let me just pull out an Excel. So you have $100,000. State interest rate was 7%. Market rate was 8%. It was for 10 years. But for input values, or the values that we're going to use, is divided by 2 or multiplied by 2, depending on the contracts. Okay. Any questions so far? Okay. So first of all, what you're going to do is to calculate the present value of $100,000 into the year 1 value. Okay, so that $100,000 was for the value at the end of year 10, right? So we're going to bring that into the present value in year 1. So in order to do that, we're going to use this $100,000, multiply that by a factor which you can get out of this table, present value table. Now, what's the number you're going to use? Going back to this, always remember that you are going to use the market rate, okay? This is key. Always use the market rate to get the factor value from the table. So we have 4%, 20 periods. So we're going to identify this 4% and 20 periods. And you see this factor value of 0.456. So we're going to multiply that by 456. Let me just repeat the process, times 456. Okay. We have that value. For interest annuity, so for this bond, okay, interest will be paid throughout the period, right? And the dollar amount was, let me just go to $3,500. Okay, so $100,000 multiplied by 7% and multiplied by that 6/12 because the interest is paid semi-annually. So for interest annuity, we're going to use 3,500, multiply that. We're going to use the same similar approach, but different table. We're going to go to present value of an annuity table, 4% and 20 periods. Here we see 13.59. So 13.59. So let me just repeat the same process, 13.59. So we have that. So in total, what that number gives me is 93,165. Now that number does not exactly match with this number. Here, as you can see, there's a slight difference because actually, what's the table? This number, this fraction number actually goes on and on. So there's a slight difference, but the idea is the same. You are going to take the present value of the principal amount and multiply that by the factor here. Same idea, you're going to use the expense amount of $3,500, multiply that with the factor value, and you are going to add these numbers together to get the proceeds or the cash amount that is received at the initiation of the bonds. Okay, now this is one approach to calculate the proceeds. In Excel, you can easily do it using a function. So what was it? I think it's so present value. You are going to use the function present value. So here it says rate. So for the rate, I'm going to use 0.04. Again, we're going to use the market rate. Now, NPER basically means the number of periods. So we said the number of periods was 20. Payment, so PMT is payment. We told you that you are paying $3,500 for the period payments. And FV is basically the future value. So again, that $100,000 is the future value or the value at the end of year 10. So at the end of year 10, you are going to pay back this entire $100,000. Now for type, I'm not going to consider that for now. So we're going to close that out. And that will give you the number 93,204 or 205. And that number exactly matches with 205, 204, 8.4. Okay. So this is the way you calculate the proceeds at the initiation. Any question?
Can you just show what you put in for proceed amount for the equation?
This equation?
Yeah.
The proceed is 93,000.
Yes. What did you use to get that again? I didn't.
So again, the function is so you're going to use equal sign PV. So that's present value. So present value, open the parenthesis. The first is, let me just use another here. PV, open the parenthesis. First item is the rate, interest rate. And we use 0.004 because the market rate was 8. And because we're talking about semi-annual basis, we divided by the 2. So here, 0.04, that was the interest rate. NPER is the number of periods, and number of periods was 20. So 10-year bond contract semi-annually, the number of periods is 20. PMT is short for payment, so interest payment, periodic interest payment, and the payment was 3,500. And the last line was FV, so that's future value. So at the end of year 10, the company will pay back this entire $100,000, right? So you're going to pay the entire $100,000, and you close the parenthesis and get that number, okay? So using Excel is quite easy, as you can see right here, but I just want you to understand how that number is calculated in the fundamental basis or in the principal basis. So Excel uses this table to compute that number. Okay. Any questions? Oh, we don't have any questions? Okay. So since 93,205 is the proceeds, the original bond face value was 100,000. So there is a difference because the market rate is higher than my stated rate. It is the discount of my bonds. So you record the discount on bonds payable at 6,795. Okay. Now, what about?
But at maturity, you owe the 100.
Yeah, at maturity, the company will pay back this entire $100,000.
Yeah.
Why don't we do premiums? Okay. I'm going to repeat the process, but using different backgrounds. So same idea, 100,000 bonds, paying 7% interest. So far the same. Market rate is now 6%, not 8%. Okay, so let's go back. Let me just delete everything here. Okay. So now it is 6%. So since, again, same idea, semi-annual basis. So you're going to divide it by 2, 3.5, 3, number of periods, 20. I'm not going to repeat the process for using the table, but let me just repeat using the function here. So PV, again, PV, the rate is now 0.03 because now the market rate is at 6%. So divided by the 2 is 3%. Number of periods is 20. The payment stays the same because the stated interest rate stayed the same. So you're going to pay $3,500. And at the end of year 10, you're obligated to pay back the entire $100,000. Okay, let's see. Enter. So this is the proceeds that the company will receive at the initiation. 107,438. Let's see if I got it correct. See, 107,439,438.7. Okay. So using an Excel is quite easy. But just understand how that number is calculated using the traditional way of using the timetable of money. Okay. Now, in this case, when bonds are issued at premium, now you have larger cash amount relative to bonds payable. So instead of recording discount on the debit side, you're going to record a premium on bonds payable on the credit side to balance the debits and credits. Okay. Any questions? Okay. Whew. Oh, that's good. So now we know how to calculate the proceeds given the information. Let's move on to the amortization table. It's quite similar to the amortization table we discussed previously, just a little bit of difference here. So we're going to start with the date. Okay, we have the date, and then we have the cash payment. And then since you are basically lending, or not lending, borrowing money from bondholders, there are going to be interest expenses accrued periodically. Okay, and there are going to be difference between the actual cash payment and interest expenses, and that difference will be added or subtracted to the carrying value. Okay, so let's start with January 1st, 2021. Okay, so in this table is using the discount example. So the carrying value of the bond is now 93,205. It's not 100,000. Okay, so the proceeds from the bonds at discount is 93,205. So we're starting with that. So since the interest is paid semi-annually, we're going to go to June 30th of 2021. Cash payment was the same throughout the period. So 3,500 stays the same throughout the period. Interest expenses, quite similar approach. So you're going to use 93,205 multiplied by market rate. Again, this is another important thing. You're not going to use the stated interest rate. You are going to use the market interest rate. Now, in this case, market rate was 8%, but because this is semi-annual basis, you're going to multiply that by 4%, and that will give you 3,728. Okay, so your cash payment was 3,500, but your interest is accruing at 3,728. So there's a difference of 228. Okay, so since interest is accruing a larger amount than what you're actually paying, the difference will be added to the carrying value. So now the updated new carrying value or book value now becomes 93,433. Okay. Now we're going to repeat the same process on December 31st, 2021. Same amount, 3,500 will be paid towards the bonds as an interest. For interest expenses, now you're going to use an updated number, 93,433, multiplied by the market rate. I again very strongly emphasize market rate, and that will give you the number 3,737. And the difference is 237. Again, that number will be added towards the carrying value of your previous period, resulting in 93,670. Okay, so if you repeat this process for 20 times, okay, if you repeat the process 20 times, at the end of the term, your carrying value will become 100,000. And that's why you're paying this entire 100,000 back to the bondholders. Okay. Any questions? Oh, very good. Oh, so no questions? So that was the amortization table. What about the journal entry? Okay. So for the first semi-annual interest payment, let me just go back. So June 30th, 2021, you're going to credit cash, okay, because you're paying this 3,500, okay? And since you are issuing a bond, you're going to debit interest expenses, and the amount was 3,728. Okay, and they do not balance out, so you have to credit something in order to balance these two numbers, 228, which was the difference here, and that will go to the discount in bonds payable. Okay. Now, there are actually two approaches to do this. Here, originally, we had proceeds and we had bonds payable, and we had discounts on bonds payable. If we are using this additional line item called discount or premium, as you are paying back interest, you are going to make changes on this additional line item, discounts on bonds payable or premium on bonds payable. Or another approach is, maybe this is much easier for you. So on January 1st, let me just use a different journal entry. So on January 21st, let's say you are using a different way of recording a journal entry. Proceeds was 93,205, and you can actually also record bonds payable at 93,205. Okay, so instead of recording at 100,000, you can actually record 993,205 instead of recording this additional discounts on bonds payable. Now, if you are following that way, what you're going to record for the interest expenses for June 30th, 21, you are going to pay cash of 3,500, okay? And debit was interest expenses at 3,728. And there is a difference, right? 228. You can actually directly credit bonds payable. So what that will do is to raise the bonds payable to this level. This is what you are actually essentially doing. So I don't do that. 93,205 plus the difference to get the 93,433. 93,205 plus the difference 228 to get that updated bonds payable number of 93,433. So there's a two approach that you can do using a, I don't want to say direct method or indirect method, but you can actually record bonds payable at the carrying value or at the proceeds amount, or you can record the bonds payable at the face value, but you use an additional line item called discount or premium on bonds payable. And depending on which approach you use, your journal entry will be different as you pay back for the interest periodically. Any questions? Okay, oh nice. So same idea goes to the second journal entry. I'm not going to write down. So you're going to credit cash, 3,500. Interest expense is 3,737. Okay, that number comes from this. Okay, 3,737, and they do not balance out. So you're going to include one more line item, 237, and you're going to credit discounts on bonds payable to balance out. Okay. And that was the case of the premium. Same idea applies. So you're starting with the larger amount of proceeds, 107,000, but the cash payment, the periodic cash payment stays the same at 3,500, but your interest expense is now lower than the cash payment. So if your interest expense is lower than what you're actually paying in cash, that difference will be used to reduce the carrying value of your bonds. So you're starting from 437, now it becomes 162 because you're reducing the carrying value of the bond by the difference between these two. Okay. So this is a graphical illustration of what's happening. So at the end of year 10, your face value or your bonds will be valued at 100,000 no matter what. But if the bond is issued at premium at 107, that carrying value will constantly decrease throughout the periods to converge to 100,000. If the bond is issued at discount, your proceeds will be somewhere around 93,000, and that carrying value of bond will constantly increase throughout the periods to converge to 100,000. Okay. Any questions so far? Okay. So when bonds issued at a face amount, the carrying value and the corresponding interest remain constant over time. But this is the key. When bonds are issued at a discount below the face amount, the carrying value and the corresponding interest expense increase over time. So what we just showed you the graph, if it is issued at discount, the value will constantly increase throughout the period. When bonds are issued at a premium, the carrying value and the corresponding interest expense decrease over time. So carrying value will decrease throughout the periods to converge to the face value of the bond. Okay. If a 10-year bond is issued at a stated rate at 9%, so I'm going to pay 9% when the market is only paying 8%. So I'm paying more than what the market is paying, so the bonds will be issued at a premium. Okay, very easy, right? So that was the issue price or the proceeds of the bonds and interest payments throughout the periods, and how you're going to prepare the amortization table, and how you're going to record a journal entry throughout the periods. Now, what about the retirement, or what about the end of the term when the time comes to pay back the bonds at the face value? Okay, so company buys back its bonds from investors. In other words, the company will pay to the bondholders at the end of the term if bonds are paid at maturity. So for example, the example that we used was the 10-year bond. So after 10 years, the carrying value will equal to the face amount. So the bonds payable is debited and cash is credited. So what that means is that you're going to debit bonds payable at 100,000. You're going to credit cash at 100,000. Okay, pretty easy stuff, right? But bonds can be retired at maturity, but bonds can also be retired before maturity, and that is called an early payment or early extinguishment. So in terms of the fancy words, we usually call it calling the bonds. So exercising the call feature includes in the bonds contract and buy bonds in the open market. So basically, if you're calling bonds, what that means is that the company will pay the bonds before the maturity. Yes, before the maturity. There you go, before maturity. It's called early extinguishment of debt. And depending on the amount that you pay out to settle this case, there could be a gain or loss on the sale or on the extinguishment of the debt. Okay, and I'm going to show you an example. So if you are just retiring your bond at maturity, you're going to just debit the entire $100,000 for cash, and you're going to debit the liability bonds payable with the same amount. So there's no gain or loss recorded on the retirement of the bonds, but this is an example here. The company issued bonds on January 1st, 2021. The face amount or the proceeds was 107,439. So what that tells me is that the bond was issued at premium. The carrying value of the bonds 1 year later on December 31st, 2021 was 106,877. Now the company retires the bonds before maturity on December 31st, 2021 for 104,353. So basically what that tells me is that on December 31st, 2021, your carrying value of the bond is 106,877. Okay, right here, as you can see right here. Now that 106,877 is composed of two components. So you have the original principal amount, bonds payable of 100,000, and you have premium on the bonds at 6,877. Okay, so the face value is 100,000. You have the premium of 6,877. Okay. Now the company is retiring the bond for the amount of 114. So your value of bond is 106, but you're paying actually at a larger amount, 114. So that sounds like a loss, right? Your value of your bond is 106, but you're actually paying more than the value of it. So you're going to first credit cash, and the information given is 114. So 114, 353, that's going to be credited. And you're going to debit the carrying value of the bond, which was 100,000, the original principal amounts. Also, there was a premium component to it, 6,877, and they do not balance out. So you're going to include one more line item called loss on extinguishment. And the difference is 7,476. Let me just write more clearly. 114,353. Okay. So that loss again comes from where the value of your bond is 106, but you're actually paying more in cash at 114. Since you're paying more for the bonds, there will be a loss recorded.
Does that mean that you issued bonds and then interest rates went down? And that's
what was that?
So if it's trading above par, then interest rates went down.
If it is trading at par, there's no premium, there's no discounts.
Yeah. So it's they issued bonds above face amount. So
above the famous, so premium.
Yes. The premium amortizes.
Yes,
so,
premium amortizes, yes.
But then when they retire it, it's 114, which means the interest rates went down since the time of issuance.
The interest rate for the bond or for the market?
No, the market interest rate went down.
So that's the so far we are assuming that the market rate stays the same.
Well, then how did it get to, then what's the 114?
That's the amount that you pay, the company pays to retire this bond.
Yeah, but if you issued it at 107, you retired at 114, it means the market interest rate went down.
That's not the way. That's quite an interesting approach to understand this. But just understand quite simply, you have the value or you have the bond with the value at 106, or it could be 107, no matter what. Okay, 106 or 107.
Yes.
But in order to get rid of the liability, in order to extinguish or retire that bond,
well, it either means there's yield maintenance or there's
there are going to be reasons as to why the company would like to pay more than what the value of the bond is. There could be different reasons. It could be the case when you just don't want to see any more liabilities in your balance sheet. It could be the case that you just have lots of money to pay back the bonds, or it could be the case where so we're talking about early extinguishments. Okay, so originally the bondholders were expecting $3,500 of interest revenues for 10 years, right? But now the company is saying, I don't want to pay you this $3,500 for 10-year periods. I just want to retire the bonds. So from the bondholders' perspective, they are losing some interest by retiring these bonds early. So in order to compensate that, the company might have to pay a little bit more than what the value of the bond is in order to reconcile the difference. Reconcile the difference. And I hope this makes more sense than the interest rate that you're talking about.
Look, I understand that if you prepay a loan early, you have to pay a premium.
Mm-hmm. That's basically the idea. So again,
okay.
The bondholders, when they signed the contract, were expecting this interest revenue.
It's called yield maintenance in debt world.
Yeah.
So I got it. I was just
okay.
thinking that it was a market function. But
yeah. But just to simply put, they're expecting $3,500 of interest revenues for 10-year period. But now the company is saying, I don't want to pay back this. I don't want to pay this interest for 10-year period. I just want to extinguish or retire this bonds early. So as a bondholder, if your intention is that, you just have to pay a little bit more than the value of the bond in order to reconcile the difference. That's basically the idea of paying a little bit more.
I got it.
Yeah.
I see it in debt instruments all the time.
Yeah, of course.
I know what it is.
Yeah. Any other questions?
Professor.
Yeah.
Does the company need to negotiate with the whoever buys their bonds to retire early?
Yes. So from part of the negotiation will be this number, right? So bondholders have to agree with the retirement amount. Okay, it could be 114, it could be 115, it could be 107. So there could be a negotiation process. But actually, at the initiation of the bonds contract, there will be a provision. Provision. Whether the bond is callable early or non-callable. So there are going to be provisions, and there are going to be a detailed information about the amount that the company must pay if the company intends to retire the bonds early. Okay.
Okay, thank you.
Any other questions? Okay. Oh, yeah.
What happens when it's a variable interest rate, like a real bond or something?
Variable interest?
Like if it's real, like indexed to something.
Oh, index. I think you're talking about ETFs.
No, like
floating rate loan.
If it's a real interest rate that you're getting on it above a certain rate.
Oh, I don't know. I really don't know. You have to refer to the experts in finance.
If you have a floating rate loan, they usually are prepaid at par. Although there's usually a lockout period in that, if that's what you're asking.
Yeah, but that's the quite advanced topic, I guess. And
yeah,
again,
not accounting.
This is not accounting. Oh, yeah, the one that you're talking about is not accounting. It's more relates to finance. Now, the focus of the course is to account for or record journal entries. Well, yeah, that's the area that I can really help with. Any other ideas? Any other questions? Brooks FRN. I don't know what that means.
I was just to his question. I was saying it's a floating rate note.
Floating rate. I see. But I've never heard of that term before. Maybe it's another provision, or I don't know. Yeah. But any other questions? Okay. Whoo. So, okay. Pricing the bonds. So calculate the issue price of the bonds. So we covered this, calculating the proceeds from the bonds. So you can use your financial calculator. You can use an Excel. You can use the table factors. Okay, I showed you an example, present value table to calculate the proceeds. But I mean, in reality, in the real world, you can use an Excel. You can use an internet to calculate the proceeds. So what you need to do, or for the exam or the quiz, I think what McGraw-Hill does is to provide you some numbers on the factor here for you to calculate the proceeds, and some questions will provide an Excel function to calculate the proceeds. So I think you have to be able to understand and you'll be able to use both types of ways to calculate the proceeds of the bonds. Yeah. Okay. But that was basically, so again, so if your stated interest rate is at 7% and the market is 7%, basically the bonds will be issued at par. So if it is issued at par, if you do the math here, the total or the sum amount of your principal and interest payments will equal to the face value. If the market is paying 8% when your stated interest is 7%, so the bonds will be issued at discount. So if you do the math, your issue price will be 93, not 100. Okay, so same idea applies here. If the market is giving 6% when my bond is paying at 7%, so that means my bond will be issued at a premium, so the proceeds will become 107 instead of 100. Okay. So, I mean, as long as you understand the basic concepts, comparing the two interest rates, you can easily understand whether the bond will be issued at a discount, at par, or at a premium. Okay. Any questions? Okay. Oh, lots of calculations today, and lots of examples. Which of the following statements is true for bonds issued at a discount? So if the bond is issued at a discount, that means my interest rate is lower than the market, right? So stated interest rate is lower than the market. Okay. A company retires a $50 million bond before maturity when the carrying value, so carrying value is 48, but the market value is 54, okay? So I have to pay 54 to extinguish or retire this bond. When the value of the bond is 48, that means I will have to report a loss of the difference between these two numbers. So again, my carrying value of the bond is 48 when I have to pay 54 to pay back, okay, to pay back the bond or the retire the bonds. You're going to record a loss of 60 million, okay? So that was the end of the chapter 9. Let me just do one practice problem set right here, and then we're going to move on to the extra credit presentation. So on January 1st, this company issues $600,000 bonds at 6% due in 10 years with interest payable semi-annually, assuming the market interest rate is 7%. Okay, so now your bond interest rate at 6% and the market is giving 7%. So obviously this bond will be issued at a discount. Oh, but the proceeds is given 557,363. Let me just quickly do the math, okay? So present value, the rate is 0.35, okay? So the market is 7% because the interest is paid semi-annually. You're going to divide it by 2, so 0.35. Number of periods, so it was due in 10 years, semi-annual basis, so you have 20 periods. Now payments, let me quickly, so let me do the math. So you have $600,000 multiplied it by 6% and semi-annual basis 6/12. And the number is, where's the calculator? Oh, that's right. That's right. Let me just quickly. Yes, nice catch, Ningshan. Where's my calculator? Where's my calculator? I lost my calculator. Okay, I'll do it in Excel. So, 600,000 times 6%, 6/12. So that's 18,000. So let me just redo it. Present value, the rate is 0.035. Nice catch, Ningshan. So 3.5%. Number of periods, 20 periods. Payment is 18,000. At the end of the period, you're going to pay 600,000. Okay. So that's 557,362. 557,362. Magic, right? So I got it right.
Isn't stated interest 6, so then that should be 3, and then the market rate is 7, so it should be 3.5.
Yes, so you always use the market rate to price the bond or to calculate the proceeds. Okay, do not use the stated interest rate. Very important.
I think you have your inputs wrong, is what he's saying.
My input's wrong? Where? So present value.
No, never mind. You're good. The 18,000 was, yeah, I saw 3. I was like, wait a second. No,
if I made a mistake, the number will be different, but okay. Anyways, nice. Let me close that out. So the complete the first 3 rows of an amortization table. So amortization table, you have the date, you have, I wish I had a ruler here. Cash payment, you have interest expenses, and you have the difference. And lastly, you have the carrying value. Okay. So January 1st, you have the proceeds of 505,763. Okay. Semi-annual basis, you're going to go to June 30th. And we calculated the periodic cash payment was 18,000. Okay. Remember, our number was 18,000. 18,000. Let's calculate the interest expense. So you're starting with the carrying value, 557,363, multiplied by the market rate. Okay, somebody calculated market rate, not the stated interest rate. So 7%, and you're going to use the fraction 6/12, and then the number is, hopefully I'm going to trust you. FinSoc's number, so 19,508. Okay. So your cash payment is 18,000, interest expense is 19,000. So the difference is 1,508. So since interest expense is larger than the actual payment, you're going to add the difference to the carrying value, and that will bring the value up to 178,855. Okay. So that's the first row. On December 31st, same cash payment, 18,000. Now you're going to use 558871, 7%. Again, market rate, 6/12. The number is, thank you, 19,560. So the difference is 1,560. So that number will be added to the carrying value. Let me just quickly do the math. 134,065. So this will be the updated carrying value of your bond. Okay. I'm not going to do 3 rows. 2 rows is fine. Okay. So record the bonds issue. Basically, write the journal entry. So let me write the journal entry. So on January 1st, I'm going to use more simple approach in this case. Okay, so on January 1st, you're going to receive cash or proceeds of 505.57,363. Okay, and bonds payable at 505.7,363. Now, like I said previously, it could be this way, or it could be cash 557,363, bonds payable at 600,000, and the difference is discount on bonds payable at the difference, like around 4,000 something. Okay, this is the correctional entry. This is the correctional entry. Depending on your preference, you're fine. But let me just go by more simplified version. On June 30th, you are going to pay cash of $18,000, and you are going to record interest expenses. The amount was 19,508. 19,508. Okay, so they do not balance out. The difference is 1,508, and that will be added to the bonds payable. Okay. Same idea, December 31st, interest expense. Now the number is, oh, now my computer is almost heating up. 19,560, 19,560. Okay, 19,560, cash payment of 18,000. Again, you have the difference of 1,560 towards the bonds payable. Okay. Any questions? Okay, so good. So, I mean, we covered a lot of things, and there were a lot of calculations, and I emphasize again, students will make a mistake using stated interest rate when calculating the proceeds and when calculating this interest expenses. Always remember to use the market rate to price the bonds, to calculate the proceeds, to calculate the interest expenses. Okay, but again, practice makes perfect. I strongly recommend you to practice as much as you can. Try to, how should I put it? Try to do this amortization table on your own to familiarize yourself with the structure of the table. Okay, but if there aren't any other questions, we're going to move on to the extra credit presentation.
Are you putting the quiz up Friday morning, or what time are you putting up the quiz?
I will make it active like 8 in the morning, 9 in the morning.
Okay, great. Thank you.
Ekaterina?
Yeah, will the final exam will be cumulative?
I haven't decided yet, but given that we have only 2 hours for the final exam, I don't think it will be cumulative. Yeah, but I haven't really decided on the structure.
Okay, good. Thank you.
Yeah. Any other questions?
So the quiz is Friday morning to
Friday
Sunday,
morning.
right?
Hold on. So Friday.
Okay. Or is it till
Friday, Saturday, Sunday?
Yeah. Okay. Or is it till Monday morning at 8?
Is that Monday like
Okay.
8 in the morning or 9 in the morning?
All right. Thanks.
Yeah. Any other questions? Okay.
On the final, would either journal entry, whether it be the cash, bonds payable, discount to bond payable, or would you prefer either one works for the exam?
I think the question will guide you in terms of which one to use. I have to double check on that. I have to double check on that. But I mean, both of the ways are correct.
Okay.
But again, I'll follow with your question later on. Okay. Any other questions? Okay. Oh, that was quite a lengthy lecture. So today we have, hopefully they are present. We have Jack Petit.
Hi.
Yeah, and then Bailey Davis. Yes. So why don't we start with Jack? So let me just stop recording.